Hello, I'm Christopher Davis from New York City. I'm interested in that many of the holdings of Berkshire are in industries that are perceived as interest rate sensitive industries, including Wells Fargo, Solomon, Freddie Mac, even Geico. And yet you have an admitted sort of ambivalence towards interest rates or changes in interest rates, and it therefore seems that you don't feel that those changes affect the fundamental attractiveness of those businesses. I thought maybe you could share your thoughts on what you see in these businesses that the investment community as a whole is ignoring.
Well, the value of every business, the value of a farm, the value of an apartment house, the value of any economic asset is 100% sensitive to interest rates, because all you are doing in investing is transferring some money to somebody now in exchange for what you expect a stream of money to come in over a period of time. And the higher interest rates are, the lower the present value is going to be. So every business by its nature, whether it's Coca-Cola or Gillette or Wells Fargo, is in its intrinsic valuation is 100% sensitive to interest rates. Now the question as to whether a Wells Fargo or a Freddie Mac or whatever it may be, whether their business gets better or worse internally as opposed to the valuation process because of higher interest rates, that is not easy to figure. I mean, Geico, if they write their insurance business at the same underwriting ratio, in other words, they have the same loss and expense experience relative to premiums, they benefit by higher interest rates, obviously, over time, because they're a float business and the float is worth more to them. Now, externally, getting back to the valuation part, the present value of those earnings also becomes less then, but the present value of Coach earnings becomes less in a higher interest rate environment. Wells Fargo, it's whether they earn more or less money under any given interest rate scenario is hard to figure. There may be one short-term effect and there may be another long-term effect. So I do not have to have a view on interest rates, and I don't have a view on interest rates, to make a decision as to an insurance business or a mortgage guarantor business or a banking business or something of the sort relative to making a judgment about Coke or Gillette. Charlie?
I've got nothing to add.
Zone 2?
Hello, I'm Benjamin Barron from New York. Could you speak about your insurance business a little bit, and especially the retroactive policies you've been writing?
We speak about did you say the reinsurance business?
Reinsurance.
Well, I heard the retroactive part, but the first part.
The reinsurance and the retroactive, and also the market in Bermuda and how you see it. It's one of your potential markets.
I think the retroactive market is what's called retroactive insurance has been pretty well eliminated by developments in accounting. So I would not expect us to really have any volume in retroactive type policies. Now, when we write workers' comp with a policyholder dividend, in effect, that's a retroactive policy. But that's a small part of Berkshire's business. Did I answer what you were driving at there? Pardon me? Did you get that, Jim?
Just comment on the development of the insurance business in Bermuda.
Oh, Bermuda is simply a new competitor. They're not so new. I mean, there have been companies in Bermuda before, but in the last 15 months, 18 months, maybe there's been $4 billion plus raised, and because for tax reasons, maybe other reasons as well, but certainly for tax reasons, that capacity has been concentrated in Bermuda-based, Bermuda-domiciled reinsurers. But essentially there's no great difference between that type of competition and other reinsurers' competition, except for the fact that capacity is new and the money's just been raised, and so there may be some greater pressure on the managers of those businesses to go out and write business promptly than on somebody that's been around for 50 years. But it's no plus for us anytime new capacity enters any business that we're in, and that certainly goes for the reinsurance business. Reinsurance business, by its nature, will be a business in which some very stupid things are done en masse periodically. I mean, you can be doing dumb things and not know it in reinsurance, and then all of a sudden wake up and find out the money is gone. And it's what people have found out, and I used that line in the report a year ago. It's what people have found out that were speculating on bonds with low margins recently, that you don't find out who's been swimming naked until the tide goes out. And essentially that's what happens in reinsurance. You really don't find out who's been swimming naked till the wind blows. Zone 3.
Right now, we are reading about various analysts and how you should, in their individual opinion, adjust your more cash, more stocks, more bonds because of. How does Berkshire Hathaway feel about times of relative financial insecurity? Do you arrange for more cash reserves, looking forward to a time when you might be able to buy, or do you go along your path?
I think the question is, do we get into asset allocation by maintaining given levels of cash depending on some kind of outlook or something of the sort? We don't really think that way at all. If we have cash, it's because we haven't found anything intelligent to do with it that day in the way of buying into the kind of businesses we like. And when we can't find anything for a while, the cash piles up. But that's not through choice. That's because we're failing at what we essentially are trying to do, which is to find things to buy. And we make no attempt to guess whether cash is going to be worth more 3 months from now or 6 months from now or a year from now. So it is. You will never see. We don't have any meetings of any kind anyway at Berkshire, but we would never have an asset allocation meeting. We would keep looking. I mean, Charlie's looking, I'm looking, some of our managers are looking. We're looking for things to buy that meet our tests. And if we showed no cash or short-term securities at year-end, we would love it, because it would mean that we'd found ways to employ the money in ways that we like. I think I would have to admit that if we have a lot of money around, we are a little dumber than usual. I mean, it tends to make you careless. And I would say that the best purchases are usually made when you have to sell something to raise the money to get them, because it just raises the bar a little bit that you jump over in the mental decisions. But we have, I don't know what we'll show, but certainly well over $1 billion of cash around, and that's not through choice. That is that you can look at that as an index of failure on the part of your management, and we will be happy when we can buy businesses or small pieces of businesses that use up that money. Zone 4.
Gentlemen, my name is Richard Surser from Tucson, Arizona. I understand that 40% of all home mortgages have been securitized by Fannie Mae and Freddie Mac, the duopoly. I would, at the risk of asking you for a projection, since you talked about projections before, I'd be interested in understanding what you think will happen to that market share over time for this duopoly. Thank you.
Yeah, well, the answer to that it doesn't involve much of a prediction. That market share is essentially certain to go up. That doesn't mean that those are wonderful businesses to buy, but it does. But the market share is essentially certain to go up, because the economics that those two entities possess compared to other ways of intermediating money between investors and people who want to borrow. No one else has those economics. So what holds the share of Freddie Mac and Fannie Mae down is the fact that they are only allowed to loan roughly $200,000 on any mortgage. That's a limiting factor. It's probably been a good thing for them that it has been a limiting factor. But they are shut out of part of the market. But the market that they are in, they essentially have economics that other people can't touch for intermediating money, including the savings and loan business that we were in. We had a business that intermediated money, went out and got it from depositors and lent it to people who wanted to borrow on a home. Freddie Mac and Fannie Mae do it the same way. They don't do exactly the same way, but they perform the same function. And they could do it so much more cheaply than we could do it by having branches or anything of the sort and paying the insurance fee we paid. They're going to get the business. They should get the business. And so their market share will grow. Charlie?
Well, I think that's right.
You're doing great. Zone 5.
Good morning. I'm Sarah Pruitt from Milwaukee, Wisconsin. And I wondered if you feel that the speed with which information is available and disseminated today has affected your business buying decision process. And do you believe that speed has caused you to miss opportunities?
Question about C's expanding?
No. Does the speed of information today affect our decision-making process?
No, I would say that we perform about like we were doing 30 or 40 years ago. I mean, we read annual reports. The speed of information really doesn't make any difference to us. It's the processing and finally coming to some judgment that actually has some utility. That is, that it's a judgment about the price of a business or a part of a business, a security, versus what it's essentially worth, and none of that involves anything to do really with quick information. It involves getting good information, but usually it's not. We're not looking for needles in haystacks or anything of the sort. You know, we like haystacks, not needles, basically, and we want it to shout at us. And I would say that virtually everything we've done has been reading public reports and then maybe asking questions around to ascertain trade positions or product strengths or something of that sort. But we never have to. We can make decisions very fast. I mean, we get called on a business or we can make up our mind whether we're interested in 2 or 3 minutes. I mean, that takes no time. We may have to do a little checking on a few things subsequently, but we don't need to get. I can't think of anything where we really need lots of price data or things like that extremely fast to make any decisions. We've got good management information systems in our operating businesses, but that's just another, that's a question of keeping inventories where they should be and all of that sort of thing. I don't think I think you could be in some place where the mails were delayed 3 weeks and the quotations were delayed 3 weeks, and I think you could do just fine in investing. Zone 6.
James Pan, New York City. I have a two-parter question. One, do you think the stock price of Berkshire Hathaway is trading within 15% of its intrinsic value currently? And two, if you think Berkshire Hathaway is undervalued with the amount of cash you have on your balance sheet, would you consider a buyback?
Now, the answer about a buyback is that we generally have felt that market conditions that would make Berkshire attractively priced are probably going to make other things even more attractively priced, because we think our shareholders are more rational than the shareholders of many companies. It's more likely that we will find some wonderful business at a silly price than we will find Berkshire at a silly price as we go along. So that tends to eliminate repurchases, but it doesn't rule them out. It explains why the circumstances will not arise very often where repurchases would make good sense. In terms of giving you a number on intrinsic value, I don't want to spoil your fun. I mean, you really should work that one out for yourself. Charlie is the expert on intrinsic. Do you have any comment for him, Charlie?
Well, your attitude on that subject reminds me of a famous headmaster who used to address the graduating class every year, and he'd say, you know, he says, 5% of you people are going to end up criminals. And he says, I know exactly who you are. And he said, but I'm not going to tell you because it would deprive your lives of a sense of excitement. Companies that constantly told their shareholders what the intrinsic value was were the real estate holding companies in corporate form. And I must say that the amount of folly and misbehavior that crept into that process was disgusting. We would be associating with a bad group if we were to change our ways.
Bill Zeckendorf Sr., I think, was probably the first one to do that with Webb and Knapp back in the late 50s. I still have those annual reports, and he would announce, you know, like to 8 decimal places what the intrinsic value of Webb and Knapp was, and he did it right till the day they filed for Chapter 11.
I remember that well because somebody said that he fell into bankruptcy, and somebody else said, how can you fall off a pancake?
Beware of people that give you a lot of numbers about their businesses. I mean, in terms of projections or valuations or that sort of thing. We try to give you all of the numbers that we would use ourselves in making our own calculations of value. We really, if you read the Berkshire reports, you essentially have all the information that Charlie and I would use in making a decision about the security. If there's anything really lacking in that respect, you know, we would truly appreciate hearing from you because we want to have that kind of information in the report. But then we want you to make the calculation. But we've stuck, I mean, that material, for example, on the float in the insurance business, we consider that quite relevant, obviously, because we use up almost a page printing it. It's pretty serious stuff at Berkshire. But that is relevant. I mean, your interpretation may be different than mine or Charlie's, but those are important numbers. And we could give you a lot of baloney about satisfied policyholders, you know, in Lincoln, Nebraska. Wouldn't tell you a thing about what the company's worth and have pictures of them and happy, you know, receiving the check from the agent, all of that. But we're not going to do that at Zone 1.
Mike Macy from Indianapolis. I have really enjoyed reading your annual letters and your annual report, and I've gone back and read all the older ones too. They're terrific. I have also enjoyed reading the 2 books by Peter Lynch. And I see a lot of commonalities between the two of you, the way you think and your philosophy, etc. I'd certainly appreciate it if you'd make a few comments on what you think of Peter Lynch, the things he says in his 2 books, and the advice that he gives to investors. Thank you.
I know Peter. I don't know him well, but we played bridge together in Omaha, as a matter of fact. And I like him personally, and obviously he has an outstanding record, and he has written those 2 books which have been bestsellers about his investment philosophy. I don't really have anything. I'm not going to embroider on his. There's certainly a fair amount of overlap. There's some difference. Peter obviously likes to diversify a lot more than I do. I mean, he owns more stocks than the names of companies I can remember. I mean, but that's Peter. And I've said in investing in the past that there's more than one way to get to heaven, and that there isn't a true religion in this, but there's some very useful religions. And Peter's got one, and I think we've got one that's useful too. And there is a lot of overlap. But I would not do as well if I tried to do it the way Peter does it, and he probably wouldn't do as well if he tried to do it exactly the way I do it. I like him personally very much. He's a high-grade guy. Zone 2.
Mr. Buffett, Mr. Munger, my name is Dave Lankus. I'm a senior editor at Business Insurance Magazine. Two-part question for you. Can you explain a little bit regarding your primary insurance operations? What drove up written premiums by more than 50% last year, and if you expect that to continue this year? And then regarding your earlier comments on the stupid things reinsurers can do en masse, can you explain what potential pitfalls that the new cat facilities in Bermuda will have to avoid that you feel Berkshire Hathaway won't fall into?
Well, the first question about our primary insurance, the figures, you'll find it way in the back someplace, but they're a little distorted because we bought Central States Indemnity late in the year 92, so that there's a lot more premium volume in there for Central States in 93 than there was in 92. Our basic National Indemnity's basic insurance, which is auto and commercial auto and general liability, premium volume was fairly flat. The home state operation fairly flat. Cyprus up somewhat, but those numbers were not anything like the changes. So our business last year, pro forma for including Central States Indemnity for all of 92, would not have shown a dramatic change. There really hasn't been much happen in our primary business, except that it's been run, it's done very well, but it is not growing or exploding, and that's true this year as well as last year. It's a good business, and it could grow in certain kinds of markets very substantially, but it is not growing in this market, and it did not grow last year, although its underwriting was very good. In the reinsurance business, I think essentially the difference in our reinsurance business from many others, it doesn't include them all in a place like Bermuda, is essentially the difference that may exist in our operations and securities versus other people. We will offer reinsurance at any time in very large quantities at prices we think make sense, but we won't do business if we don't think it makes sense, just like we will buy securities to the extent of the cash we have available if they make sense. But we have no interest in being in the stock market per se, just to be in it. We want to own securities that make sense to us. I think for most managements, if the only thing they're in is the reinsurance business, they may like it better when prices make sense, but I think they will be prone to do quite a bit of business when prices don't make sense as well, because there's no alternative except to give the money back to the owners, and that is not something that most managements do somersaults over. So I think we are in a favored position, essentially having the flexibility of capital allocation that lets us take the lack of business with a certain equanimity that most managements probably can't, because of their sole focus on the business. Rates will get silly in all likelihood after a period when nothing much happens, when you've had a couple of years of good experience. We price to what we think is exposure. We don't price to experience. I mean, the fact that there was no big hurricane last year, I forget the name of the one that was coming in at North Carolina and then it veered out essentially, but to us, it has nothing to do with the rates next year, whether that hurricane actually came in a big way or veered out into the Atlantic again. I mean, we are pricing to exposure. And everyone says that, but the market tends to price and respond to experience, and generally to recent experience. That's why all the retrocessional operations in London, and the spiral went busted, because they priced, in our view, they priced to experience rather than to exposure. It's very hard not to do that, to be there year after year with business coming by and investors expecting things of you and not do that. But we will never knowingly do that. We may get influenced subconsciously in some way to do that, but we will not do that any more than we will accept stock market norms as being the proper way for us to invest money in equities. basically, when you lay out money or accept insurance risks, you really have to think for yourself. No, you cannot let the market think for you. Charlie?
Yeah, I think Berkshire is basically a very old-fashioned kind of a place, and it tries to exert discipline to stay old-fashioned. And I don't mean old-fashioned stupid. I mean, the eternal verity, so to speak. Basic mathematics, basic horse sense, basic fear, basic discriminations regarding human nature, all very old-fashioned. And if you just do that with a certain amount of discipline, I think it's likely to work out quite well.
Zone 3?
David Gottesman from New York. It's no wonder that this meeting draws stockholders from all over the country. And despite the talk about age today, I'm happy to say this meeting gets better every year. Berkshire stands unique in American business as a company whose name has become synonymous with management excellence. Unlike many American corporations, we as stockholders don't have to worry about reorganizations, large write-offs, massive restructurings, overstated earnings, and overpaid executives with strategic visions. Instead, year in and year out, we enjoy the benefits of the common sense and brilliance of Charlie and Warren.
What did you say your name was?
I want to add to that, to say nothing of your good humor. It's easy to take such consistently outstanding results for granted, but we in this room are the direct beneficiaries of their efforts. By our presence here today, we show our appreciation to them for their exceptional performance, but we can also demonstrate it in another way. I would like to suggest we give them a rousing hand of applause for a job well done. Thank you.
Thank you. That was Sandy Gottesman. We've worked together for 30-odd years, and he's finally got that down. I appreciate that, Sandy. With that, we will adjourn, and anyone who wants to stay around, we'll reconvene in 15 minutes, and then we'll be here till about 1:15. And for the rest of you, there's buses, candy, etc., world books out there. Thank you. Zone 2 now. Well, I don't know where Zone 2 is, but we'll...
Do you feel basically the same about your investment in Guinness now as when you made the investment in terms of the company?
Well, I wouldn't like to comment on anything that we own in terms of how we rate them as desirability or anything. I mean, whether it's Coke or Gillette or anything, we made decisions at a given time at a given price, which you can figure out by looking at our purchases. But we may be buying or selling any of those securities right as we talk, and we simply don't think it's in the interest of Berkshire shareholders as a group to be talking about things that we could be buying or selling. Okay.
Hi, David Winters from Mountain Lakes, New Jersey. I'm just wondering, World Book's had a tough time lately, and I'm wondering if there's things you're doing to try to improve that. And also, the Buffalo News has been fabulous, and I'm kind of wondering what's driving the Buffalo News.
Buffalo News is doing what?
Fabulously.
Yeah, well, it's doing well, right. Well, I would say you got to give credit to Stan Lipsey. I'm not sure whether Stan's here right now, but who's been running the news. World Book, in terms of unit sales, as we put in the report, have fallen off significantly the last few years. It's actually surprising in a sense how well the profits have held up, because they've done a good job, and very good job in that respect. And as we put in the report, we don't know the answer precisely. Ralph Shea has taken some actions, is taking some actions that that he thinks will improve the operations. Ralph's record as a manager is absolutely at the top of the list. I mean, I wrote about it in the 1992 report. In 1993, Ralph did even better. I mean, it was fabulous. I think I'm probably may have been 110 or so million pre-tax on 90-some million of average equity capital or something of the sort. So it's a fabulous record. But Encyclopedia Britannica, as you probably know, ran at a loss last year. The encyclopedia business has been poor. Could be due to electronic competition. Could be due to recruiting problems for salespeople. Obviously, can be a combination of many factors. If we knew the answer, you wouldn't be seeing those figures right now. But it is a top item of attention for Ralph. He takes anything that's not performing as well as before very seriously, and we will see what happens. But I don't have a prediction on it. I wish I knew the answer. I don't see any variables to in any intelligent way tell you, or we put in the report the best we could do on that. The profitability, as like I say, has been pretty good, but obviously current trends of new sales will catch up with us at some point unless we boost unit sales. I don't think our market share, if you look at print encyclopedias, has fallen, but I can't be sure of that, but I think that's probably true. But there are an awful lot of encyclopedias going out there as part of a bundled product with computer sales. How are we going to do this? Is there?
You got 3 now.
Okay, I'll let you hand the mic to whomever. Yeah, you.
Lee again from Palo Alto. By Omaha standards, you are a relatively young man, and every year you point out that Berkshire's size now precludes you from making the great, relatively small trades which made your reputation. How much thought have you given to breaking up Berkshire into smaller entities?
How much what?
How much thought have you given into breaking up Berkshire into smaller entities which would allow you to make those nice, small, wonderful trades that you made from the beginning?
It wouldn't do any good to break into smaller entities because I'd still own, we'd still have 10 billion plus of capital to be responsible for wherever it would be. So we could distribute it out to the shareholders and let them make their own decisions, obviously. And anytime we thought that we weren't going to get more than $1 of value per dollar retained, that obviously would be the course to follow. But there's no magic to creating multiple little. I mean, we could call Berkshire 2, Berkshire 3 $1 billion to invest, and it doesn't really solve anything. Charlie, do you have any thoughts on that?
No, Berkshire is incredibly decentralized in terms of power and decisions resting in the operating divisions. In terms of the marketable securities, it's incredibly centralized. And so far, we have not had any big penalty from not being able to do the things that we did when we were young. Eventually, we will reach the penalty.
Yeah, I think there's no question we could earn higher percentage returns working with $100,000 though than $10 billion. But
yeah,
but it hasn't hurt us as much as we thought it would as size has increased. But your universe of opportunity shrinks. But it shrinks no matter. I mean, you can set it up in 20 bank accounts or one bank account, but the universe still has to fit the 10 billion in aggregate. Now, how are we doing this? Do we have another zone over there? Yeah.
Michael Bunyaner, New York City. Two questions. One, last year you discussed in your annual report your investment in General Dynamics, and you also gave your proxy to the company and its management. This year, it appears you have sold the stock.
This year what?
this year it appears that you have sold the stock in General Dynamics. What has changed that you sold 20% of your stake? This is question number one, and I have number two.
Mm-hmm. Probably inappropriate to be talking about what we're buying or selling, except to the extent that we have to make a public announcement, which on something like General Dynamics, we've got 13G requirements if we change by more than 5%, and we also have, as long as we own more than 10%, we have monthly reporting requirements under Form 4. We think the management of General Dynamics has done an absolutely sensational job. Obviously, also, it isn't the kind of business, basically, that we have a 20-year view on or something of the sort. So the shareholders of General Dynamics have been extraordinarily well served by the management of that company, and we're thankful because we've prospered accordingly.
But should I take from this comment that you have changed your view about the business itself?
Pardon me?
Should I take from your comment that you have changed your view about the business itself?
No. I think you can take my comments as saying just what I've said.
Okay. Question number two. Could you
I think we want to give people a chance around the room, and then when in the zone you're in, when a second question comes along, we'll be fine. But we want to get as many people in this hour as we can, because this is the hardcore here. Zone one.
It appeared to me that in 1993, the variation between the stock price for the high and the low was much greater in years in the past. Would you mind commenting on that?
Well, there was more volatility in the price of Berkshire last year, and as I put in the annual report, the stock overperformed the business last year. Now, over any 10 or 20 or 30-year history, every year the stock is going to perform a little differently, at least, in the business. I mean, it may slightly underperform or slightly overperform. We would prefer that those variations be as small as possible, but there was more variability last year than historically has been the case, although we've had a few years like that. Our best way to handle that is to give all the information we can to shareholders and prospective shareholders and follow policies that we think will induce the investment oriented with long time horizons to join us, and not to encourage other people. But occasionally, we can't guarantee that result. One of the things that was interesting to me, I don't know whether it was 3 months ago or when, but I happened to be talking to the specialist, terrific specialist, Jimmy McGuire. He had to leave, but he was here earlier in the session. And I think at the time the stock was around 16,000 or something like that. And he had some rather significant stop loss orders on the books at 15.5 or thereabouts, involving some hundreds of shares. To me, it is a signal that, we have some people that are, in my view, are not really the kind of owners that we would like to attract, because why somebody wants to put in an order to sell something for 15,500 that they don't want to sell at 16,000 is beyond me. But the idea of people using stop loss orders with Berkshire, obviously, it tells me that we've got some people in that are using it as a trading vehicle of some sort, or have some totally non-investment type calculations in their mind. I don't think we have very many of them. But obviously, if we have enough people like that, you will have a more volatile stock than if you have a whole bunch of people who look at it as something that they're going to hold for the rest of their life. And the stock did go down at that time and hit 15,500, and there were I think it was close to 300 shares, which is $4.5 million worth of stock. And somebody made a decision, apparently, or some small number of people made a decision that they wanted to sell something at 15,500 and that they could have sold for 16,000. The lower it went, the better they liked it, apparently. I mean, the better they liked the sale. Which, has always struck me as like having a house that you like and you're living in, and, it's worth $100,000, and you tell your broker, if anybody ever comes along and offers 90, you want to sell it. I mean, it doesn't make any sense to me. But it has, I would say that there's been some small, I think relatively small tendency for people to get, relatively few people, but to get more interested in the price of the stock than in terms of, and thinking of it in terms of whether it's going to go up or down in the next 6 months than might formerly been the case. I think we're unusually well blessed in that respect, in that we've got people who basically want to own it for a very long time. But to the extent that you get people who are owning it because they think the stock market's going to go up or something of that sort's going to happen, that is not good news from our standpoint, and it will increase the volatility in it. We will do nothing to encourage that. Zone 2?
Yes, Mr. Buffett, Steve Lang from Toronto. I was just curious about when you were saying that one of the best things that could happen to shareholders is the market goes down and you're able to buy good businesses at foolish prices. And then a little later on you were saying that we could judge your ability to do what it is that you feel you should be doing by how much cash you have in the account at any given point in time. And
by what?
By the amount of cash that you have in the account. In other words, I guess what you feel you're supposed to be doing is investing the cash in good businesses. So I'm just wondering about that kind of dichotomy. Where does the cash come from if the market does go down? If you've been successful in your first ability, would that be from the cash flow on the operations of the business, from the float? Is that so really the success of the company then is to some degree the fact that you're able to dollar cost average into the market on an ongoing basis? Is that right?
Well, it isn't that precise, but A, we do generate cash in the considerable amounts, so that we will not husband cash simply because we think the market's going to go down or to buy something. But obviously, as cash comes in, we're always looking for things to do, and the cheaper that the market is generally, the more likely it is that we will find something that we understand and that we like, and that the price will be attractive and that we will do. But it isn't like we can change around the whole portfolio then, because that doesn't gain us anything. I mean, we'd be selling things at lower prices to buy things at lower prices. But to the extent that we have net cash coming in, which we do and which we will have, on balance, we are adding to our businesses at more attractive prices than would be the other case. And it's no prediction on any given company. I mean, whether it's Gillette or Coke, or it might be something we already own, it might be something we don't own, but we welcome the chance to buy more shares. We're not wishing it on anybody, but if you asked us next month whether Berkshire would be better off if the whole stock market were down 50%, or where it is now, we would be better off if it was down 50%, whether we had any cash on hand now or not, because we would be generating cash to buy things. Zone 3?
Byron Ransdale from Raleigh, North Carolina. Thanks for your hospitality this weekend.
Well, we thank you for coming, too.
My question concerns Solomon Inc., and more specifically Solomon Brothers. I know that you on the board of directors, I think from 87 to the current time, very much interested in compensation there, and maybe on the compensation committee. Between 1987 and 1992, Solomon's financial results were dismal, in a very lumpy way, but overall quite dismal. In your opinion, if the compensation had been rational during this time, would Solomon have shown results that would make it a quite decent business?
Would Solomon have, if the compensation
if the past compensation
been more rational,
decisions had been more rational, 87 to the current time, would Solomon have done better? Yeah, is that it?
Yes, sir.
Well, I would say that if the present people and the present compensation philosophy, which allows for very large payments for very large results, I think the company would have done better. You're going to see very big numbers paid in Wall Street. That is the nature of it. The trick is to pay them only when you're getting very big results for the owners. I mean, there's no way you're going to pay numbers that look like numbers in other industries and get great results for owners. But if you pay these big numbers, I think you should be getting very good results for owners. And the old system was not. I mean, it wasn't totally off the mark on that, but it was far from an ideal system in my view. Zone 1.
Warren, I have one question. last year you were using Coca-Cola puts as a way to increase income, and conversely, if they were exercised, as a way of increasing your position. Do you still use puts in this type on investments you wish to add to?
5 million shares, as I remember, of Coke sometime in the early fall or thereabout. I don't remember exactly, last year. And the puts, I think the premium was around $7.5 million, and they were priced around 35. We have not done that very often, and we're unlikely to do very much of it. For one thing, there are position limits on puts which don't apply to us, but they apply to the brokers for which we do them, and those position limits were not clear before that, but we could probably write puts on that same amount by doing it through a bunch of different brokers. It's not something we're really very likely to do. I was happy to do it, and in that particular case we made $7.5 million, but we're better off probably, if we like something well enough to write a put on it, we're probably better off buying the security itself. And particularly since we can't do it in the kind of quantities that really would make it meaningful to Berkshire. There are securities I would not mind writing puts for 10 million shares or something, but that probably, it's probably allowable for us to do it. It's not allowable. We'd probably have to do it through multiple brokers to get the job done. And on balance, I don't think it's as useful a way to spend my time as just looking for securities to buy outright. Charlie, do you have anything? No. Zone 2?
Mr. Buffett, I'm from West Point. My name is Rogers. A couple of months ago, there were stories in the World Herald that Berkshire Hathaway had taken a large position in Philip Morris and UST. But in your annual report, I don't see anything about that. Can you comment?
Yeah, I would say in the last 2 years, maybe, I'm just approximating, I've probably seen reports in either the Wall Street Journal, USA Today, maybe picked up by the Associated Press or in the Herald, but in papers of some significance, I've probably seen stories that we were buying maybe any one of 10 companies in aggregate over that period of time. I would say a significant majority were erroneous. We don't correct the erroneous ones, because if we don't correct the erroneous ones, if we correct the erroneous ones and don't say anything about the correct ones too. So we will never comment on those stories, no matter how ridiculous they are. It's interesting because, they keep getting printed, and frankly, from our standpoint, the fact that most of them are inaccurate is probably useful to us. We don't do anything to encourage it, but the fact that people are reading that we are buying ABC or XYZ when we aren't, that's I don't think people should be buying stocks because they're reading in the paper that we're buying something. But if they do, they may get cured of it at some point. Maybe the newspapers will even get cured of writing the stories when they don't know what the facts are. But it's something we live with, and we'll probably continue to live with. And I would say that based on history, if you read something about us buying or selling something other than through reports we filed with the SEC or regulatory bodies, the chances are well over 50%. That I can tell you based on history is correct. Well over 50% that it's wrong. Zone 3?
Do you expect that Berkshire would become one of the Standard & Poor's 500 stocks or a Dow Jones stock?
Well, I think it's unlikely it ever becomes a Dow Jones stock. I don't know what the criteria are for the S&P 500, but I imagine there's some reason why we don't fit. I don't know whether they have questions about number of shares outstanding, or I've never checked with S&P. I wouldn't be surprised if we have the largest market capitalization of any company that isn't in the S&P, although I don't know that. But they may have some criteria variety that preclude Berkshire being part of it. I've always thought it'd be very interesting for those of you who like to think about such things, that if we were part of the S&P 500 and enough people became indexed so that 60% of the market was indexed, and if Charlie and I wouldn't sell, which we wouldn't, it'd be an interesting proposition as to how the index funds would ever get their 60% if they tried to replicate the S&P. I don't know whether they have rules even about concentration of ownership. That same line of thinking might have applied to Walmart or some company. Because just take the extreme example of a company that had 90% of its stock owned by one individual and 12% of the money in the market were indexed, and the 90% wouldn't sell. It would bring back the Northern Pacific corner or something of the sort. In any event, I don't think that's going to be a problem, and I don't think we are going to end up being in either index. Yeah, Zone 1.
Mr. Buffett, my name is Aaron Morris. I'm from California. What I wanted to know was how you think about how large a position you're willing to take in a given security, both in your case where you have new cash coming in that you can invest, and in a case of an investor where they have a fixed amount of capital and they're trying to decide what's the most they should put in a security that they really love.
Well, Charlie and I have, probably at our present size, we will never find anything that we get as much money into as we want. I think that's probably true, Charlie, if we really like it.
Yeah, I think that's quite likely.
Yeah, so we will probably never hit the limit. We'd love to find something we felt that strongly about, and occasionally we do, but we won't get as much money into it as we would wish, or as if we were running $1 million of our own money or some number like that. So we are willing to put a lot of money into a single security. When I ran the partnership, the limit I got to was about 40% in a single stock. I think, Charlie, when you ran your partnership, you had more than 40%.
Sure.
And we would do the same thing if we were running smaller partnerships or our own capital were smaller and we were running that ourselves. Because now we're not going to do that unless we think we understand the business very well, and we think that the nature of the business, what we're paying for it, the people running it, and all of that lead up to virtually no risk. And but you find those things occasionally, and we would put, assuming it were that much more attractive than the second and third and fourth choices, we would put a big percentage of our net worth in it. We only advise you to do that. Probably don't advise you to do it at all, maybe, but we would only advise you to do it if you're doing it based on your own conclusions about your own ideas of value and something that you really feel you know enough to buy the whole business. If your funds were sufficient and was being offered to you, you ought to really understand the business. But people do that all the time, incidentally, in private businesses, which have got terrible prospects. I mean, they buy dry cleaning establishments or filling stations or whatever, and they put very high, or franchises of some kind, they put a very high percentage of their net worth into something that a business is very risky, basically. I mean, people put all their money in a farm. You know, it's a business. It's subject to all kinds of business risks. So it's not crazy if you understand the business well, and if the price is sufficiently attractive to put a very significant percentage of your net worth in. If you don't understand businesses, then you're better off diversifying, and fairly widely diversifying.
Go ahead. Sorry. Berkshire has a substantial shareholder whose father accumulated the original position, and when he died, he left a very large estate, practically all of which was in two securities, Berkshire and one other outstanding company. And a bank was co-trustee, and the bank trust officer said, "You've got to diversify this." And it was a very large estate. And the young man who was co-trustee with the bank said, "Well," he says, "you know, if my father had believed the way you do, he might have been a trust officer in a bank instead of leaving this large estate." And that young man holds the Berkshire to this day, and I suppose the bank is still giving the same advice.
Zone 2.
Mr. Buffett, this is Chuck Peterson from Omaha, and I was just wondering if you could comment on the Coca-Cola Company. Haven't really talked about it too much today in regards to what you foresee over the next 5 years, the earnings per share growth, and where this growth is perhaps going to come from.
Was that the question about the growth of Coke?
Yeah.
You really have to come to your own conclusion. The Coca-Cola Company writes, their annual reports are extremely good. I mean, they're very informative. My guess is that, at least if you read a few of the reports, you absolutely know as much about the Coca-Cola Company as I would. But in the end, you have to make your own decisions about growth, potential profitability, potential, and all that. But the one thing I can assure you is that probably not, if you spend a relatively small amount of time on it, the facts that you will have available to you for making a decision on that question will be just as good, essentially, as the facts you'd get if you'd worked at the Coca-Cola Company for 20 years, or if you were a food and beverage analyst in Wall Street or anything of the sort. That's the kind of businesses we like to look at, are things that we think we can understand that way, and they're also businesses that usually I think you could understand that way. But we don't like you to give you our answers. I mean, that would not be a good idea. Zone 3.
David Swab from Austin, Texas. I have a question pertaining to the convertible bonds that were outstanding for about 4 years. Any thoughts on, if you're a teacher to grade, if that was a good deal, bad deal, how the money was employed compared to the cost of getting out of the bonds? Any thoughts?
Charlie, did you get that?
He wants to know if you think, in retrospect, your deal with the Lions was a good deal for Berkshire.
No, I would say that if I knew everything at the time that we did the Lions deal, which was a convertible zero coupon debenture, if I knew everything then that I know now, would we have done it? Probably pretty close. We had relatively few bonds converted when we called them, and so that it really wasn't a negative in that sense. But if we'd had more, we could have easily had a lot more converted, and that would not have been so good, obviously, if we'd ended up selling a lot of stock at 11,800 or whatever it was. It's very hard to measure exactly what we did with the 400 million or so that we took in at the time. So money being fungible, separating that 400 million from other resources to measure what happened on the plus side from having the money is hard to do. But my guess is, a whole hand over again, it probably was maybe a tiny minus to have issued them. What do you think, Charlie?
Certainly close to a wash. Yeah. Now you can ask about U.S. Air, and that is one we would have been well to duck.
Yeah. And I might say Charlie had nothing to do with that decision. He didn't even know about it till I did it. And when he knew about it, Zone 1.
Mr. Buffett, I'm Joe Sertivan from Toronto. With respect to Berkshire's non-permanent but large and therefore illiquid holdings, what is your strategy for managing market impact on sales, given the intense scrutiny that Berkshire is under by the market?
I didn't get that either.
I'm not hearing that very well.
Yeah, I don't know whether you're too close to we're having a little trouble on that.
Speak a little more slowly.
Or maybe the monitor could repeat that. Would you repeat the question?
Okay. Sorry. Just with respect to Berkshire's large non-permanent holdings that are therefore illiquid, I'm just wondering what your strategy is for managing market impact when you do decide to sell portions of those holdings, given the intense scrutiny you're under.
Question about the things we might sell and what's going to happen to the market when we sell them. That depends. I mean, it can be a very significant impact. It can be a negligible impact, and depends on market conditions. It depends on whether we might sell in a couple of large blocks to some institutions. It depends on, it could be, there could be a tender offer or something of the sort we would sell through. So it's hard to measure, but it is a disadvantage. Size is a disadvantage. You're absolutely correct in the basic point, both in buying and in selling. And we don't know any way around that. So we allow for it in terms of what we expect, the kind of possibilities we need to see. And we sell so infrequently that it's not a crusher of a negative point, but it's a negative we have that you do not. Zone 2.
My name is Inez Ripley. I'm from Roanoke, Virginia. Does Berkshire Hathaway or any of its subsidiaries have key man insurance on you and Mr. Munger?
Does Berkshire have key man insurance on?
Oh, no. We have no life insurance, to my knowledge, on anyone except the maybe standard little group life contracts people have. We have no key man insurance. It really doesn't. It wouldn't be material. I mean, if we have a market value of $18 billion or something like that, and if it really didn't, if it made a 1% difference, it'd be $180 million. And basically, the math of intelligently selling insurance is better than the math of intelligently buying insurance. Zone 3.
Mr. Buffett, I'm Barry Ziskin from Mesa, Arizona, longtime admirer of yours. Question pertains to Guinness. I remember reading in a publication I greatly respect, Outstanding Investor Digest by Henry Emerson in New York, that back in, I think it was 58 or 59, you made an investment in Cuba, decided never to make an investment outside the United States again at that time, have subsequently invested in Guinness. I'm a fellow investor in Guinness, have invested in Guinness and its sister company, Louis Vuitton Moet Hennessy, for over 5 years. And I'm very happy with those investments, by the way. There's been a restructuring, as you know, of the Guinness-LVMH relationship, where Guinness no longer owns 24% of LVMH. Rather, it owns only its distilling, or I should say, alcoholic beverage-related businesses.
Part,
right, the Moet Hennessy part. The other parts of LVMH are showing better results these days, namely the Louis Vuitton luggage as well as the Christian Dior perfume. They've also expanded into the newspaper business this past year, business that you understand. Do you intend to look at the possibility, first of all, of participating in those businesses that you no longer own now with the restructured Guinness LVMH deal through some other form? And the second question relates to the currency risk inherent in the Guinness investment. Having bought it at about $1.80, as you mentioned, pound sterling now down to about $1.48. The cost of hedging foreign currency through the FX has diminished through the combination of lower interest rates in the UK and the higher interest rates most recently in the US to just about zero. I take it we're all investors in companies, not speculators in currencies. So the second part of the question is, do you intend to do anything about the currency risk portion of that investment?
Well, LVMH, which as you mentioned was 24% owned by Guinness, that's one of thousands of securities that we could be a buyer or seller of. So I really don't want to comment on LVMH's specific attractiveness or lack thereof. And Guinness, I think what Guinness did was quite logical. I mean, their interest in that operation was basically through the distribution advantages that it gave to Guinness's own brands around the world to be hooked up with Moet Hennessy and vice versa. So I think what they did was logical. You can the question of the exchange rate and all of that, the exchange rate in terms of what they got in the spirits business versus what they gave up in the luggage businesses and Christian Dior and a few things. You can form your own opinion on that. But I think the logic was sound. But in terms of whether we want to be an LVMH by itself, that's That's like any other security, which we really can't answer. Second question related to
hedging.
The hedging
Do
of
we
currency.
hedge?
The answer to that is we don't. And Coca-Cola, as I mentioned, gets 80% of their earnings from a variety of currencies. The yen and the mark being two very important ones. They're going to be getting a very high percentage 5 years from now, 10 years from now. They do certain currency transactions, but it's a practical matter. If you own Coca-Cola, you own a bunch of foreign bonds with coupons on them, denominated in local currencies, that go on forever. Now, should you try and engage in currency swaps on all those coupons? You don't know what those coupons are yet because you don't know how much they're going to earn in Japan or Germany, but you do know it's going to go on for decades, and they're going to be very significant sums. Should you try and engage in a whole bunch of currency swaps to go on out and convert all that stream into dollars? We basically don't think it's worth it. We don't think our opinion on currencies is any good. We think the market probably we know it knows as much about it. It probably knows more about currencies, but we do not know more than the market does about currencies. So there are costs to hedging, and even though interest rate structures may cause the curve to look flat going out forward, so that in effect there's no contango on it, there's still the cost. There are costs in it. Now it's a relatively efficient market, so that they're not huge. But we see no reason to incur those costs with what we regard as totally a 50-50 proposition, and it really doesn't go out that far anyway. I mean, we could do it for a couple of years, but if you take the way we look at businesses being the discounted flow of future cash out between now and Judgment Day, we can't really hedge that kind of a risk anyway. We could keep rolling hedges, but there's a cost to it that we don't want to incur. We wouldn't worry a whole lot about whether some portion of our earnings, whether it's from Guinness, whether it's from Coke, whether it's from Gillette, are denominated in some mixture of marks and pounds and yen and dollars, or whether they're all in dollars. We'd slightly prefer it if it were all in dollars, but we don't lose sleep over the fact that it may be coming from a mix of currencies like that. We wouldn't like it in terms of, obviously, some very weak currencies. Zone 1.
Lawrence Grom in Mill Valley, California. On page 13 of the annual report, on talking about the insurance operation, you say that it possesses an intrinsic value that exceeds its book value by a large amount, larger, in fact, than is the case at any other Berkshire business. To refine an earlier question that was asked, could you tell me whether you mean that it is larger by a percentage or in absolute dollars? That is,
by absolute dollars.
That's what you're referring to.
Yeah, by absolute. It's very hard to stick a percentage figure on the insurance business because we have so much capital in there and we have other businesses. I think that we've got businesses with a book value of in the tens of millions that are worth in the many hundreds of millions. So you couldn't apply that to the insurance company base. So it's absolute dollars. But in terms of absolute dollars, we think the excess of intrinsic value over carrying value, at least I do, is substantially greater for the insurance business than any other business we own. Charlie, do you have any thoughts on that?
That's exactly right.
Joe Little, Vancouver, Canada. Does the management succession issue for the top job at Coca-Cola concern you?
Management picture, you do what with
the management succession issue over the next several years?
Oh, yeah.
The top job. Does
at
that
Coca-Cola?
concern you? Yeah.
I think any announcement from that would come from Coca-Cola.
He said, do you like it? Does it concern you?
Oh, I'm not concerned at all, no. Now, Coca-Cola is very well managed. Zone 3?
Yeah, Chris Stavru from New York. According to the latest Salomon Brothers proxy, if Derek earns 30% on allocated equity of Salomon Brothers, provided that that's at least 10% above the return for competitors. He could earn a bonus of $24 million. My question is whether that return number is reduced by a charge for preferred dividends.
Charlie, do you remember on the comp committee?
I can't remember the detail on that.
I think the equity, I'm fairly sure, but I'm not positive, that the equity figure would include our preferred but not non-convertible preferreds, and it would apply to the earnings applicable to our preferred plus common, but it would be after dividends on non-convertible preferred. But I'm not on the comp committee, and I have not read the description that carefully.
Well, I am, and I can't remember. But I will tell you one thing I do remember about that, and that is a target which would be hellishly hard to hit.
It'd be unbelievable.
You're talking about Babe Ruth
squared.
Yeah, doing 150 home runs in a season instead of. If that happens, you'll be very glad to pay the money.
Under either calculation. Yeah, it really. But I'm glad it's there. I hope Derek's paying attention to it. Zone 1.
Hi, Chris Davis again from New York. I wanted to ask if I feel there's such a huge discrepancy between the valuation of some of your holdings versus others in terms of the market valuation, in terms of price to earnings, price to book. In your opinion, do the growth prospects of Salomon Brothers or the quality or your anticipation of your ability to clip the coupons at Salomon Brothers justify such a dramatic discount to the growth prospects of Coca-Cola or Gillette in terms of our ability as Berkshire shareholders to clip those coupons? And if you could explain or perhaps share your thoughts on why the market perception, if it is, justifies that distinction.
Yeah, I'm not sure I can answer that question without getting into a discussion of the relative merits of the two companies or the three companies you mentioned at these prices. But Salomon and Coca-Cola are obviously very different kinds of businesses, or Salomon and Gillette. And Charlie and I do our best to try to understand the businesses. Obviously, it's easier to understand the future of a Coca-Cola than it is a Salomon, but that doesn't mean it's a better buy. And what you see at any given time in our holdings is partly the historical accident even of when we bought and when we had money available and all that. But it reflected an affirmative decision at that point, obviously. And our guess would be that we would feel reasonably good about anything that we owned in terms of the price at which we bought it and the facts at the time we bought it, and the facts change over time. Salomon, I think, is a better company now than it was some years back, but it's still in a business that's can be very volatile, and it has a small amount, as does any investment banking firm and does any commercial banking firm, of systemic risk. I mean, you can't get rid of that. Charlie, you want to?
No, I've got nothing to add.
Zone 2.
Thank you. Sean Berry, Regina, Canada. Mr. Buffett, you've indicated that most of us in this room could acquire a lot of the information that you and Charlie acquire through the annual reports. Yet you both also indicated that the GAAP rules a lot of times leave a little to be desired. Could you perhaps give an indication as to how you and Charlie come up with the economic value or the intrinsic value of the businesses that you finally decide to invest in, and a little bit about the process that you go through with that? Thank you.
Well, in the 1992 annual report, we discussed that a fair amount, but the economic value of any asset essentially is the present value, the appropriate interest rate of all the future streams of cash going in or out of the business. And there are all kinds of businesses that Charlie and I don't think we have the faintest idea what that future stream will look like. And if we don't have the faintest idea what the future stream is going to look like, we don't have the faintest idea what it's worth now. So if you think you know what the price of a stock should be today, but you don't think you have any idea what the stream of cash will be over the next 20 years, you've got cognitive dissonance, I guess is what they call it. So we are looking for things where we feel fairly high degree of probability that we can come within a range of looking at those numbers out over a period of time, and then we discount them back. And we are more concerned with the certainty of those numbers than we are with getting the one that looks absolutely the cheapest, but based upon numbers that we don't have great confidence in. And that's basically what economic value is all about. The numbers in any accounting report mean nothing per se as to economic value. They are guidelines to tell you something about how to get at economic value. But they don't tell you anything. There are no answers in the financial statements. There are guidelines to enable you to figure out the answer. And to figure out that answer, you have to understand something about business. You don't have to understand a lot about mathematics. I mean, the math is not complicated. But you do have to understand something about the business. But that's the same thing you would do if you're going to buy an apartment house or a farm or any other small business you might be interested in. You would try to figure out what you are laying out currently and what you are likely to get back over time, and how certain you felt about getting it, and how it compared to other alternatives. That's all we do. We just do it with large businesses, basically. The accounting figures are very helpful to us in the sense that they generally guide us to what we should be thinking about, and of course, if we find numbers where it looks like people are taking the most optimistic interpretation of things that they can under GAAP and all of that, we get very worried about people who look like they massage the numbers in any way. And there are plenty of people that do. Zone 3.
I'm Howard Baskin from Kansas City. When you are estimating a growth rate on a company of a very predictable company, I imagine you apply a big margin of safety to it. What kind of rate do you generally apply? I mean, high single digits?
In the margin of safety, or
what kind of growth rate would you, on a predictable company, might you
We are willing to buy
stab at?
companies that aren't going to grow at all.
Okay.
Assuming we get enough for our money when we do it. So we are not looking. We are looking at projecting numbers out as to what kind of cash we think we'll get back over time. But would you rather have a savings? If you're going to put $1 million in a savings account, would you rather have something that paid you 10% a year and never changed, or would you rather have something that paid you 2% a year and increased to 10% a year? Well, you can work out the math to answer those questions, but you can certainly have a situation where there's absolutely no growth in a business, and it's a much better investment than some company that's going to grow at very substantial rates, particularly if they're going to need capital in order to grow. There's a huge difference in the business that grows and requires a lot of capital to do so, and the business that grows and doesn't require capital. And I would say that generally financial analysts do not give adequate weight to the difference in those. In fact, it's amazing how little attention is paid to that. Believe me, if you're investing, you should pay a lot of attention to it. Charlie?
I agree with that, but it's fairly simple, but it's not so simple. It can all be explained in one sentence.
Some of our best businesses that we own outright don't grow, but they throw off lots of money which we can use to buy something else, and therefore our capital is growing without physical growth being in the business. And we are much better off being in that kind of a situation than being in some business that itself is growing, but it takes up all the money in order to grow and doesn't produce that high returns as we go along. A lot of managements don't understand that very well, actually. Zone 1.
Byron Ween from New York. You said that you decentralize the operating decisions, but centralize the capital allocation decisions. What kind of staff do you have in Omaha to help you with the capital allocation decisions and the stock selection decisions you make? Or do you and Charlie do that pretty much by yourselves?
Yeah, we don't have any staff to help us on it. I mean, basically, we tell them to mail all the money to Omaha, and then when we get there, we put our arms around it, and we allocate all the capital ourselves. I mean, that is our job, and we don't feel we should delegate. I mean, we wouldn't do it anyway. Our personalities aren't such that we would delegate allocating our own money to somebody, letting somebody else allocate our own money. But we feel that's our job, and it's interesting, and I've written about this in the past, that's an important job for most managements. There are some companies where it's not, but it usually is a very important job for most managements. And if you take a CEO that's in a job for 10 years, and he has a business that earns, say, 12% on equity, and he pays out a third, that means he's got 8% per year of equity. I mean, when you think of his tenure in office, how much capital he's allocated, it's an enormous factor over time. And yet, probably relatively few chief executives are either trained for or are selected on the basis of their ability to allocate capital. I mean, they get there through other routes. So I've said it's like, somebody playing the piano all their life and then getting to Carnegie Hall and they hand them a violin. I mean, it is a different function than the functions that exist along the routes to the CEO's job at most companies. And so many CEOs, when they get there, think they can solve it by either having a staff that does it or by hiring consultants or whatever it may be. And in our view, that's a terrible mistake, because it is, if not the key function of the CEO, it's one of two or three key functions at, say, 80 or 90% of all companies. And if you can't do it yourself, you're going to make a lot of mistakes. You may make a lot of mistakes even if you do it yourself. But if you wouldn't want anybody in any other position of that importance in the company essentially saying, I don't know how to do this, so I'm going to have somebody else do it, when it's their key responsibility. But that's the way it works in business. And Charlie and I take responsibility for all capital allocation decisions other than just sort of routine expenditures at the operating businesses. And we don't get into those at all. I mean, if our managers are spending $3 or $4 million a year on machinery, or one of them is, on machinery, equipment, plants, new leases, we have no review process on that. We don't have a staff at headquarters. We don't waste the time to do that. We think those people know how to allocate the money that relates to the actual operations of their business. We think in terms of the capital that is generated above that's our job. Charlie?
Yeah, I would say we have practically nobody at headquarters in Omaha. And one of the reasons Warren shines up so well is, he's being compared to practically nobody.
I might say, one interesting, when we're having this meeting, for example, I think there's one person there in the office. I mean, the rest of them are down here helping on the meeting.
Here we are, Warren and I are selling candy and encyclopedias and so forth. The chief financial officer of Berkshire Hathaway is handling the microphones. I mean, this makes Southwest Airlines look like they don't understand
cost control.
Cost accounting. I mean, it's a very old-fashioned place. And by the way, speaking of hawking our merchandise, if any of you have safety deposit boxes full of Berkshire Hathaway certificates and have children or grandchildren who don't have World Book in print in the house, you are making a very serious error. That is a marvelous thing to have in a house.
And the discount only applies today. Incidentally, I think that's right.
It is. That is it. It may not be selling too well because of the current vogue for encyclopedias on computers. And by the way, those encyclopedias that are available are inferior compared to World Book, which is very user-friendly for children, and I like it that way myself. And that is one product you really ought to buy.
We both use it personally. I mean, I keep a set at the office and a set at home, and
I give away more of that product than any other product that Berkshire Hathaway makes in any subsidiary. It's a perfectly fabulous human achievement to edit a thing to make that user-friendly and with that much wisdom encapsulated. It's a fabulous thing.
Zone 2.
Pat Sadukan from Houston, Texas. From time to time, you have quoted John Maynard Keynes, the British economist. So I would assume that you have read his investment writings very extensively. What are 2 or 3 investment lessons, in your opinion, one can learn from that economist?
Well, I forget which. I think it's chapter 8 of the General Theory. You remember, Charlie, or is it chapter? No. There's one chapter in the General Theory that relates to markets and the psychology of markets and the behavior of market participants and so on. That probably, aside from Ben Graham's 2 chapters, 8 and 20, and The Intelligent Investor, I think you'll find you'll get as much wisdom from reading that as anything written in investments. And you'll know it when you see it in the General Theory. It's a chapter that jumps out to you about the securities and so on. And it could be chapter 8, but I may be wrong on that. But I would recommend reading that. Keynes and Graham, from vastly different starting points, came to the same conclusion at about the same time in the 30s as to the soundest way to invest over time. They differed some on their ideas on diversification. Keynes believed in diversifying far less than did Graham. But Keynes started off with the wrong theory, I would say, in the 20s, and he essentially tried to predict business cycles and markets, and then shifted to fundamental analysis of businesses in the 30s and did extremely well. And about the same time Graham was writing his first material, I think Janet Lowe in her book on Ben Graham actually has a little correspondence that took place between Keynes and Ben. So I would advise you to read that. And there's some letters of his of Keynes's that he wrote to co-trustees of life insurance societies and colleges and so on that I think you'd find interesting too. It's 1:15, and Charlie and I have to go to our directors meeting at Berkshire, which starts in about 15 minutes. So we thank you all for coming.